And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Thursday edition of The Real Investment Show, second best day of the week, of course. Michael Lebowitz will be joining me this morning as well. Got a lot of stuff to catch up on. I was out for the last couple of days. Went to a distressed credit and investment banking conference. I was presenting on a panel there. I actually wound up moderating it. The guy that was supposed to moderate the panel got sick the night before, so they were like, "Hey, Lance, can you moderate it?" So wound up moderating a panel all day, but really, really interesting stuff. Very different views about what's going on in the commercial real estate market versus what you hear in a lot of the headlines. You know, this is always kind of the case. You know, we hear these more dire headlines about commercial real estate. There's going to be this giant real estate crash, etc. That's likely not going to be the case. There are some pretty major players in that space right now, particularly in the distressed credit area, that are absorbing that inventory and getting it off the books of the banks. So it's going to be interesting to watch here. It's been kind of the slow motion kind of roll. But again, you know, one of the, kind of the big headlines have been, everything's going to come apart at the seams next year because of all this commercial real estate. But very quietly behind the scenes, banks are getting a lot of that commercial real estate off their books at a pretty rapid pace. Deep discounts being put out. Buildings that just a few years ago traded at $150 to $200 million being sold off of the bank's books at 25 to 30% on the dollar. So again, very, very big discounts on the distressed credit side getting picked up by a lot of these players in the market. And it's very interesting. It's a small number of players in that overall market. There's only about 500 players in the whole market. So lots of opportunity on that distressed credit side if you've got the willingness to step into that arena. But outside of that, while it was gone, markets had a couple of really strong days. Now, we talked about on Thursday, that was the last time I was here. On Thursday, markets were declining, and then we said, look, we're getting really close to support at the 100-day moving average, set right on top of that moving average support. That led to a very, very nice rally on Monday, Tuesday, Wednesday. Markets actually finished about break even. So again, very nice bounce off that 100-day moving average. Not surprising, as we discussed, markets have gotten pretty oversold. So seeing a bit of a bounce there, not surprising as well. So again, that's just, that's kind of expected. Now the question, right, is the correction over? Now, we're going to talk about that in a second. But one thing to pay attention to at the moment, of course, is a lot of this economic data is coming in. We've got some important reports coming out. We've got PCE this week. That's the Personal Consumption Expenditure Index. That's the index that really the Fed pays most attention to, while the media kind of focuses on CPI and what's going on with CPI and rents and those type of things. The Fed pays attention to the trimmed mean PCE. So that's the index that is part of that personal consumption expenditures that makes up about 68.5% of the GDP equation. So again, that's why that's a very important component. That's what they're going to pay attention to. We're going to get that data to see what that looks like. Now, one thing we kind of keep, seeing, or discussing, of course, is this, kind of economic strength that's going on. Again, the economy is doing well, no doubt about that, but that strength is what's keeping a lot of these inflationary pressures a bit elevated, right? It's always about supply versus demand, basic economics. Right now, demand is okay. The question will be, though, can demand continue at current paces through the rest of this year, right? So if we're going to have this sustained rate of higher inflation, you've got to keep having demand stay at this level or higher, right? So that demand continues to outstrip supply, creating inflationary pressures. We'll see if that's going to happen. But a lot of this economic data that we're looking at from the National Federation of Independent Business, tomorrow I've got a report on retail sales coming out. A lot of that data says that is not the case and that we are going to see weaker rates of economic growth as we get further into the year. And that, of course, translates into slower rates of inflation. Okay, so here's what you need to know before the bell. Again, kind of talking about the markets. Markets had a very nice sell-off. We had talked about previously for like 2 months. It kind of got, I'd say, just kind of ad nauseum every day. It was like, hey, market's rallying, we're very overbought, take profits, reduce risk, rebalance your portfolio. Now, none of that meant sell everything and go to cash, right? It just meant, just be a little bit prudent about your risk management, et cetera. Because we said, look, a 5 to 10% correction is going to be very possible, in the coming months, just because we've gotten so deviated from the 200-day moving average. That was one of the kind of the big issues, is just this deviation that you had from the 200-day moving average has to close. And we're still working on closing that gap. We're likely not done with that. To close the 200-day moving average, of course, is going to pull us down to around 4,700 by the time we get there. So there is risk to the downside. Don't think that we're completely out of the woods just yet. But again, we did have a 5.5% correction from the peak. So, if we're going to be talking about, 5 to 10%, we hit that first mark. That was the 5.5% correction to that 100-day moving average. So we've completed potentially the first leg of that. We're now going to get this kind of reflexive rally. And that's what we saw here over the last couple of days. We talked about, hey, you get a rally back towards this 50-day moving average, which we got close. We didn't quite get there, but we had this reflexive rally that reversed some of that really oversold condition in the market. We have not turned up onto a MACD buy signal yet, so we don't have it all clear yet to put a lot of equity exposure back into the markets just yet. And yesterday, both Meta, Facebook, and IBM kind of pooped the sheets, so to speak, in terms of earnings. Really interesting, Mark Zuckerberg, actually earnings for Meta were okay. Nothing wrong with earnings coming out of Meta yesterday. But Mark Zuckerberg went through everything that he could find about how they just burn cash. And, it's like, we've just got a big furnace over here. We're just throwing cash into it left and right. Markets didn't like that. Meta's going to be down about 12, 13% this morning, maybe a little bit more. Futures are pointing lower because Meta is such a big component. IBM, also consulting revenues dropping rather sharply for IBM. That's leading to a big decline in IBM shares this morning. So that's going to weigh on the Dow because IBM is still a component of the Dow. So, you're looking at the S&P being down about, 0.5% or so this morning, about 34 points. The Dow is going to be down a couple of hundred points. So again, it's not dramatic, but very likely we're going to come down, and this is going to be the important thing. We're going to come back down to retest this 100-day moving average, that support. So if the markets can hold that level at the 100-day moving average, have a successful retest of that, put in a double bottom, then we're likely going to be kind of through this correction because, again, stock buybacks will come back in about about a week or so, but effectively about 2 weeks. Stock buybacks will really start to come back into the market, which have been gone now for the last month. So we'll get that reinvigoration of corporate share buying. That'll help kind of lift the markets once we get into May, June. So again, potentially a little bit more weakness here. Now, that's the optimistic view. The pessimistic view is that the market fails at that 100-day moving average, and we're going to test that 200-day moving average, completely close that deviation from the 200 days. So don't get me wrong, there is risk to the downside, but bearish sentiment and investor sentiment bullish sentiment, investor allocation sentiment is reversing sharply. We're about halfway through that sentiment reversal cycle, and retail net buying has already dropped back to the lows. Those normally suggest that we're likely closer through finishing this corrective process than not. But again, we got to navigate it. So just be a little bit cautious. Look for some opportunities. If you want to add some stuff to your portfolio, been looking for those opportunities. There's some stocks going on sale. That's okay. But be a little bit moderated with it and wait for this market to give us a little bit better signal before increasing exposures back to full weight. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz on the other side. Lots of stuff to talk about to catch up over the last couple of days. Don't go away. More of The Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. Lots of economic data out today. So again, there's going to be, a good bit of stuff kind of moving markets. Of course, as I just said, IBM and Meta really kind of driving the show early this morning. But today we've also got advanced trade and retail goods, retail inventories, wholesale inventories. Pay attention to those. Right? Again, we talked about before about supply and demand, and that's what drives inflation, right? So if you start seeing inventories really start to pile up on the books of both wholesale and retail members, that's that increase in supply. And that also suggests at that point that if supply is stacking up, that means that consumption is falling. And this is really kind of a part and parcel of our article tomorrow on retail sales, is that the retail sales in February and March were not nearly as strong as they looked on the surface. And particularly when you look at the trend of sales since last October as well, suggests that the retail consumer is indeed slowing down. And so if you start seeing inventories really start to pile up, that's a deflationary issue, right? Because eventually that inventory is going to have to get liquidated at a lower price. That brings down prices. Also today, we've got the advanced first estimate for GDP. So, GDP, there's always three estimates for GDP. The first estimate of GDP is simply just a average of economist estimates. So they kind of take the blue chip Wall Street economists, get their average for GDP, because there's no data in yet, right? It's the first quarter is just now over at the end of March. So we're just now starting to collect data for the first quarter. So they just use a general estimate for the first estimate. In the second and third estimate for GDP, which we'll get over the next 2 months, that's where we get actual data. And that's why, typically the first estimate tends to be the strongest. Not always the case, but the first estimate tends to be the strongest, and then you get a little bit weaker as you get the other two. But GDP for the first quarter is expected to come in around 2.4%. And Mike, correct me if I'm wrong, but I think Atlanta Fed's closer to about 3%. Is that correct?
I think they came down recently. I think they're right around 2.5, 2.6.
Okay, so
in the same ballpark.
Okay, yeah. So 2.4% today. The chain deflator, of course, that's also the inflation print for GDP, which is expected to be at 2.9. Now that is up from 1.6 prior. So certainly showing some inflationary pressures through the deflator. So anyway, that data is going to be parsed by the markets today. And again, we're kind of going through it. We had this nice reflexive rally. What we'd said, previously in both our newsletters and Mike and I had talked about is that, use this initial rally to rebalance risk if you need to. And that also means, again, it doesn't necessarily mean just sell stuff. That also means buy stuff, right? So if stuff's really gotten beaten up and you need to add some exposure or want to change out positions, whatever, use this rally to raise a little bit of cash, reposition your portfolio, et cetera. We're going to have another decline, but most likely there's a very high propensity that this market will decline again before, we make the next attempt at a rally to all-time highs. Just remember that it's always a cycle, but, we're working through that process. Mike, I was gone the last couple of days. Any kind of takeaways from the markets? You were watching them much more closely than I was able to.
No, it was actually very quiet with you gone. It was kind of nice.
Thanks.
No, the markets, they've been driven. It was Tesla yesterday, Meta today. Earnings are a big deal. And what I thought was kind of interesting is if you read Tesla's earnings, they were awful.
Yeah.
They lost $2.5 billion in cash flow. Earnings were below estimates. Revenues below estimates. But they came out and said that they're going to be mass producing a people's car, a cheaper car that can compete with the I guess like the Accords and the cars that are the best sellers.
Right.
So that got everyone hyped up on Tesla.
And just real quick,
Meta,
and it was interesting because I had actually made a bet on Tesla with the guy the day about 3 hours before the earnings announcement. I said the stock's going to have a huge rally after the market. Doesn't matter what they report. There was a 3 million share short position sitting out on Tesla, one of the largest short positions ever. And so going stocks has already had a big decline. So it was almost inevitable, no matter what they said, somebody would find good enough rally, something out of it to rally. And of course, that's what happened.
Well, here's the takeaway I think we should all learn. Yes, you're right. It was so oversold that all they had to do was announce earnings, and it was probably going to bounce, barring them saying something completely horrendous. But the narrative from it was that despite a rough quarter, Tesla is doing things both on the AI front, the auto driving front, and this mass-produced car, that everything's going to be great in the future.
Right.
So that just shows you how technicals are kind of the move, the reaction. It was very oversold. Earnings came out. I guess it was a relief. The stock rallied. Then when a few hours later, you look, well, why is the stock rallying? And you see all these excuses.
Right.
Those are the narratives.
Exactly.
And the narratives are formed after the move, after the technicals have done what they're going to do. So when we talk about technicals all the time, that's what matters. And now you got Meta. I haven't gone through their earnings, but from the headlines I've seen is they're pretty good.
Yeah, I was actually going
to.
I was going to. Stock's down pretty sharply this morning. It's had a huge rally though, but stock's down pretty sharply this morning. But I thought, the earnings were good. First quarter earnings on beat analyst expectations on top and bottoms lines. What got them was, kind of a little bit of a disappointing forecast. And it's interesting you say it's a disappointing forecast. It just disappointed the analysts, which were uber optimistic that, Meta is going to grow revenue and earnings to the moon. They see revenue in the second quarter at $36.5 billion to $39 billion, which was just a little bit short of the $38.2 billion in revenue. So all they did was kind of shift the range down a little bit. They still clipped the top end of the range at $39 billion. So it's still possible they could hit 38.2, but they shifted the range down a little bit. And that's right. What everybody's upset about this morning. So that forecast is going to clip about a few $100 million in market cap off Zuckerberg's wealth this morning. We'll see.
Poor guy.
Yeah.
But that's the narrative. But Lance, just like Tesla, that's the narrative, right? I mean, the stock was high flying.
Yeah, it was up 131%. Yeah, Meta was up 131% over the last 12 months, 39% year to date. And so it's going to be down 13-14% today. We'll probably add some more of it to our dividend model.
Right. So the lesson from both of them is narratives are fine, but look at the technicals, and they'll give you a better indication of where things may be going. And, it's not just Tesla and Meta, it's the market, it's Apple, Microsoft, Google, who still have earnings to come.
Mm-hmm.
How Apple's been performing pretty poorly, especially compared to the market.
Right.
So, Apple is kind of not nearly as bad as Tesla, but it's in that Tesla camp. If they, as long as it's not horrendous news, you probably get a rally out of Apple.
Right.
So,
and by the way, we have Microsoft this afternoon. So again, we're right in the cusp of that, as Mike's talking about, right in the cusp of these, all these really big companies. By next Friday, we'll have about 80% of the S&P 500 will have reported. So we're gonna have a really good handle on just how strong or weak this earnings season is, and particularly starting to look forward here. But again, we're gonna have a lot of headline risk over the next day or so, particularly if you own Microsoft. There's going to be headline risk this afternoon based on whatever they say.
Right. And based on what we've seen so far from the big companies, 10% moves should not be unexpected.
Yeah. Unfortunately. So it certainly makes investing in portfolios interesting the last couple of days. But, we talked a little bit previously kind of, and this is, about inflation over the last couple of weeks. Bond auctions were a little bit tough this week. Again, there's a lot of people that point to bond auctions, say, oh, that the bond auction was terrible or good or whatever, and they try to make some narrative out of that. But if you look at kind of a chart of bond auctions, they're all over the place. There's really no correlation of the data to anything, why one bond auction is weak and then the next week the bond auction is superb and the next week it's weak again, and they're just all over the place. But the bond auctions were a little bit weaker. We had $39 billion yesterday in a bond auction. Was pretty weak. Any takeaways from that?
It wasn't that weak. It was slightly worse than where it was trading before. But, these are narratives. Mm-hmm. So the narrative is the bond auctions are weak, saying that demand is not good. And look, some of that, there is some logic to it. I'm not completely poo-pooing it. But what we only hear about are the bad auctions. Right. There was a really, really good 20-year auction last week that you didn't see anything about. So when you have a narrative, you hear about the parts, the data, the information that supports the narrative, right? With the Magnificent Seven last year, when they were running all by themselves, it was all because of AI and everything they were going to do with AI and this, that, and the other. And data that came out supported it, and it just made the narrative stronger. Well, it's the same with the Treasury auctions. There's good ones, there's bad ones. And like we've talked about, what they really represent is the supply and demand equation within 24 hours of the auction, right? Not a long-term lookout. Yeah. And there's a lot of game playing by the dealers, by the big banks and brokers on Wall Street.
Real quick before we hit the break. These bond auctions have nothing to do with the deficit and spending and all that. Again, the deficit did make a difference 24 hours before the bond auction. That's already factored in, right? So, all right, quick break. We'll come back. Overconfidence in NFL drafts, a lesson for investors. We'll talk about Mike's latest article on the website because it kind of goes into this whole thing we're talking about this morning on kind of catching up on things. But we'll talk about that coming up after the break. Article is on the website now, realinvestmentadvice.com. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices. advice. So many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food. Yeah. And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. 6:33 as we get this morning underway here in Houston, Texas, where it's been muggy and humid. Humid and muggy. All right, now listen. So I was at this conference, right? So normally I go to bed like at 8:30, 9 o'clock because we get up so freaking early, right? So I was still having to get up early to, get everything done before the day and get to the conference and all that. And so, but everybody's keeping me out till like midnight, 1 o'clock, which is way past my bedtime. So, and then I get home till close to midnight last night by the time I landed the plane and got here. So I'm running on very few hours sleep at the moment. So anything that I say or do this morning is just off the record. So anyway, Mike, little bit about your article, because again, this kind of feeds into what we were talking about earlier about investor sentiment and consumer sentiment and kind of everything that's been kind of driving the market. We've had a lot of very, very bullish sentiment. And I thought it was interesting, in last October, everybody was uber bearish. And if you looked at investor sentiment, consumer sentiment, everything was very, very bearish last October. Then November comes along, the market starts to rally. And by January, everybody's uber bullish and like this market's never going to stop going up. It's everything is all on fire. It's all great. And it's interesting, we've only had a 5.5% correction already. You're seeing a lot of bearish headlines. I just had an article hit my inbox a second ago on the break talking about the bull market from November is over. The new bear market is starting. So it's very interesting just how quickly, narrative changes and sentiment changes and confidence in things change. And I thought you wrote a really interesting article on this talking about overconfidence in the NFL drafts. And it was interesting because this morning CNBC is starting their stock draft for this year. So, here we are, 5.5% corrected. Now we're going to have a stock draft. So tell us a little bit about what you wrote.
So tonight is a huge night for Washington Commanders fans like myself. So we have the second pick, and we finally have a new owner, and we have a general manager that actually knows what he's doing.
Doesn't mean you're going to win anything, but it's
the first time in 30 years. And you guys in Houston, you're kind of part of this story.
Yeah.
Last year, you had the second pick. Well, you haven't won much either, but you had the second.
Fair enough.
Right? You had the second pick. So there were two quarterbacks at the top. And everyone was confident that Bryce Young, who went to Carolina, was the guy. And C.J. Stroud was good, but second, right? Mm-hmm. Turns out C.J. Stroud may be a Hall of Famer or at least a Pro Bowler. And the jury is certainly still out on Bryce Young. So regardless, I've been reading a lot of articles on the draft, and one thing I've noticed is that's very interesting is the first four of the first five picks are likely going to be quarterbacks. And you read these reviews on the quarterbacks, and almost all of them are outstanding. These are going to be the next stars in the NFL. But what's really fascinating about it is that's not the case. And these draft picks are extremely valuable. The first pick is the most valuable, and they fall off pretty quickly. But the first five picks have extreme value. You can trade one of those picks for another first round, a first round next year, a second round, a fourth round. You can trade it for a lot, right? You can diversify. Yep. And that's important to kind of keep in mind. But Warren Sharp from Fox Sports wrote an article right before last year's draft. And this is really what kind of got me to write the article. Since 2011, and he chooses 2011 because that's when the contracts with first round draft picks changed. So it made it easier to draft a quarterback in the first round. There have been 38 quarterbacks drafted in the first round. You know what their overall record is, all 38?
Well, I have the article in front of me, so I can tell you, but go ahead.
The market. One below 500. They basically performed just like the market. Then you consider Patrick Mahomes as one of them. Mm-hmm. So you start throwing out his and maybe the top one or two other quarterbacks. And with all the confidence GMs have over these picking quarterbacks, it turns out they're below par, right? Their record is pretty poor. The average starting time is about 3.5 years for 28, the quarterbacks that already passed their rookie deals. So they're drafting mediocrity. So what this reeks to me is overconfidence. Why not trade out of that pick, draft four or five other players, knowing that the odds are you'll get two or maybe three good players, and do kind of the smart thing. Right. I know a quarterback's an important position, and this doesn't translate perfectly to the stock market, but leave your confidence at the door. No one beats the market. I quote in their DFA funds has a stat that 25% of investors beat the market consistently. So if you can't beat them, join them. So the bottom line is play smart. When you have one valuable pick, diversify into three or four. Don't fall into groupthink. Groupthinks are these narratives. Narratives are very important, and it's important to be a part of that narrative, right? To own some of those Magnificent Seven stocks last year was important for performance, but don't get wed to the narrative. Know that the narrative is a rationale and that it will change, as we're talking about this morning with Meta. Yeah, we've seen it with Apple.
And it is interesting. I mean, this is kind of the thesis behind, Moneyball, right? The movie Moneyball, which was,
right.
Look at the stats of players who aren't necessarily the top of the league, but can consistently, get on base, whatever it is. And while it was interesting, if you haven't watched the movie, it's a good movie to watch. But, it's kind of the same premise. If you look at your stats, again, it's like from the group from the 38 quarterbacks, 28, past their contracts, their average time was 3.4 years. And to your point specifically, if I would have used that first round pick instead of picking the quarterback, I could have done a lot more with it potentially to round out my team, make it better. But, what's interesting is, and again, this kind of goes back to, looking at statistics and the way things play out in the overall market, and also just the difference between leagues, right? When if you're a star quarterback in college, that's a vastly different game.
Right.
You know, the gap between college and pro, the speed at which the game moves, the timing, et cetera, is just vastly different. And you find out where that skill gap is pretty quick. And it's the same thing really between professional investors and retail investors. You know, professional investors have, we're talking about hedge funds and, other type of fund managers out there that have access to a tremendous amount of data. Ray Dalio once said, he goes, I have 500 PhDs on staff, billions of dollars in assets, hundreds of millions of dollars invested in research and research capability, and you think you're going to beat me, right? And that's really the difference between, what's going on in the market and, retail investors. They're chasing a narrative. They're just buying stocks that are going up, rather than looking at what's driving those stocks, what's the information moving those stocks, and then, of course, when that data and when that narrative actually begins to change under the surface. And again, this is, as I was saying at the beginning of the show, commercial real estate has been the narrative, right? And we're gonna have this massive, crash in commercial real estate. It's going to be the next financial crisis. If you take a look at what's happening underneath the surface with the data, that may not be the case. But if you're betting on that being the case, you're kind of playing college ball and you're not necessarily playing pro ball.
Right. Warren Sharp in his article basically gives advice, and he says zig while others zag. And I think that is so appropriate for us. You don't have to be a contrarian, but please understand contrarian views. Read research that doesn't make you comfortable, that's opposed to your point of view, to the market's point of view, because no one is going to be right? Someone will be right, but most people will be wrong, and most likely those popular narratives will be wrong over time. So understand the contrarian view. Don't overstay your welcome in a narrative, as we're starting to see with the Magnificent Seven. Take profits along the way, so you're reducing your risk but still participating. So, and it's just fascinating how Moneyball, the NFL draft, these are all just human behaviors, and they translate into all these things that we do in life. And the stock market, bond markets are no different. They're behaviors, and they're these traits that at times we have to fight because they're so powerful, and they lead us to want to follow the crowd for groupthink. And they create this level of confidence when you have a really good year that, I can beat the market every year. Well, statistically, that ain't going to happen.
Yeah, I have a friend of mine named Doug Cass who runs a hedge fund, and he calls it group stink. because it's kind of the same thing you're talking about. It's like, if you're following groupthink, you're always going to ultimately be on the wrong side of the trade, because by the time the whole herd moves to wherever he is, it's really, kind of far too late to make any money off of it, which is probably a valuable point. All right, quick break. Right. We're going to come back. We'll pick up with Michael Lebowitz, finish up the show this morning. A couple other things to get into, kind of from the economic standpoint, right? Lots of, we've continued to have strong economic growth. The general consensus right now is absolutely no way we're going to have a recession. Is that groupthink? We'll talk about the risk of that on the other side of the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Getting ready to wrap things up. So one of the big questions is, and the big debates is between the markets and what people see in headlines. And in particular, we talk about inflation and, plenty of stories about the cost of eggs and gas and, things that are going on. There's this big disconnect between the average consumer and what at least seems to be going on Wall Street. There's kind of interesting data that here we are into a presidential election year. The economy printed, 4.9% in third quarter of last year, right at 4%. The fourth quarter of last year was going to print 2.5% growth in the first quarter of this year, roughly. We'll find out today. But there's really no evidence that, the economy is not doing well. Unemployment remains extremely low, et cetera. So when you look at the economic data headlines, certainly seems as if there's no recession on the horizon whatsoever. Yet you take a look at the polls, right? And the number of people approving of the economic situation right now is extremely low. Kind of closer to a record low for a presidential election year to have such a dour outlook on the overall economy. So, what is it? Is the economy booming, or is there something else actually going on? And Mike, it was interesting. So I was at this conference, and the conference, broke for dinner, and the dinner was at the Steakhouse. And, for kind of high-end steakhouse, place is packed. People are ordering drinks and, $250 bottles of wine. I mean, just, and if you looked at that steakhouse, and there's a point about this. So if you look at the steakhouse, and of course, I'm walking around talking to people and I'm like introducing myself, saying, well, what do you do? It's like, oh, I own, 4,000 apartments, in this town and, whatever. So lots of money inside of the steakhouse, and certainly doesn't seem to be any indication of concern over how much people were spending for a steak and a bottle of wine or anything else. Well, I noticed across the street was kind of a pub, and just kind of an everyday, kind of retail pub and kind of bar that you see like a Baker Street and that type of thing. So I walked our street, place is dead empty. I mean, there's like 3 people in the whole place. And I was like, is this a is something going on? Why is there nobody here? It's like, oh no, we've been dead for months now. And in fact, we may be closing here soon if, things don't start to pick up. But, it's very interesting because, again, this is the data, right, that we see, right? So you survey the average American, they're at the pub, right? And then you have the top 10% of income earners that own all the wealth, and they're doing great. But that doesn't necessarily show up in a lot of this economic data. So when we're talking about, strong rates of economic growth, strong stock market, low unemployment, that doesn't necessarily represent what's happening in the underlying economy. And the question to you is, does this eventually show up in much weaker economic growth down the road?
In theory, it does. But, we continue to see this huge divergence in wealth and the effect it has on the economy. When you were talking about that, it reminded me of a joke. Bill Gates and I walk into a bar and the bartender says, oh, a couple billionaires on average, right? And that's the problem. Bill Gates, people like him, these billionaires have so much money, and the wealthy, not just the billionaires, but there's a lot of money in few hands. And if they spend the money, it can make the economy look good. But if the rest of the 90% can be in a recession, and it's just the way economic data is compiled, it's hard to tell. So you look at it's shocking how low Biden's economic confidence numbers are. And Democrats, they separated out between Republicans and Democrats. So you take out kind of that political angle from it. Mm-hmm. Just among Democrats, it's very weak. And you have one of the best economies at least statistically, that we've probably seen in our careers, Lance. It's fascinating, but I think what it tells you is that prices are a problem. Not necessarily inflation, but prices. We had our inflation, and prices are still there, if not higher. And that's the problem. And our wages, on average, have kept up, but I think a lot of people's wages have not kept up.
Right.
And when they don't keep up, you're actually taking a pay cut. That's what's really going on.
Right. And you just brought up a really important point that we need to focus on real quick, because this is the argument of people when they talk about inflation. They go, yeah, inflation's coming down, but the price of eggs and the price of dairy, et cetera, are still super high. Declining rates of inflation does not mean prices come down. It means they don't change in theory, right? So again, we talked about this before. If the price of eggs is $4 a dozen on January the 1st of this year, and they're $4 a dozen next year, you're still paying $4 a dozen for eggs, but the rate of inflation is now zero, right? And that's the important thing that we have that we need to remember. And one of the things that kind of gets lost in translation when we talk about inflation, they go, well, inflation's coming down, but the price of what I spend on living hasn't gone down at all. And that's doesn't mean it will. It just means that the rate of change has gone down.
Right. So it's all relative, how much you make compared to the rate of change in prices. And we know wages have gone up a lot. We make more money today than we did. So affording that $8 loaf of bread is not fun, but it's not the same as if I would have told you a loaf of bread was $8 in 5 years ago before the pandemic.
Right.
But I think people still realize they're not getting as much. A lot of people are realizing they're not getting as much for their money. And then when you consider that 90% of this country has people that are really not invested in the stock market, they haven't been able to offset it, right? The inflation hurts everyone from Bill Gates down to the bum on the street. The difference is Bill Gates has stocks. He has bonds. He's able to create with his wealth additional wealth above the rate of inflation, and in his case, grossly offset it. But as long as you have some assets, you have a chance of beating inflation and taking away the negative effects of the inflation. So again, it's that wealth gap, and I think it's playing havoc with our numbers. The other thing I think that's really hard is inflation itself. I contend you can't calculate inflation. There's no way you can tell me what inflation is for a country, because you have 50 million Americans that all spend their money differently on different things, different places, locations. It's impossible to calculate. Every store has a different price for the same thing. You got things like shrinkflation. You got all these games that are played by producers, sales, etc. So we don't really know what inflation is. We know how it's trending, whether it's up or down, but we don't know what it is. So when you consider that we're going to get GDP in a half hour, and they're going to give you two numbers. One number is nominal, and it's going to say the economy grew at probably 6%. I don't know what the estimate is. I don't even know what the estimate is because no one looks at that number.
It really looks real.
Right. And they look at real, which is after inflation. So they take that, let's just say it's 6%, and they say inflation was 3%. So real GDP was 3%. But if you think about it, a huge part of the real GDP calculation is their PCE, their price, their personal consumption price index, inflation. So it just has a massive effect on all data. Retail sales doesn't even adjust for inflation, for instance. Everything that does adjust for inflation is not using the right number. And I'm not saying I know what the right number is, but no one knows what that right number is. And some people's inflation may be 8%. Some people may be in deflation, depending on what they're buying and when.
Well, that's right. In the end, so just using the numbers today as an example, the deflator is expected to come in at 2.9. So let's just call it 3. And GDP is expected to come in at 2.5, right? So nominal, you just add those two together, you get 5.5, right? So nominal GDP today should be about 5.5%, which is strong, right? I mean, you know, there's nothing wrong with 5.5% economic growth, but unfortunately, it's not feeding through. And again, kind of going back to my example, it's clearly not feeding through to the bottom 80% of workers that are just, you know, trying to pay bills, trying to pay the utility costs, trying to make ends meet, raise their kids. And again, it's being reflected in the presidential polls. And I think we're going to see it reflected at the election in November. It'll be interesting to see because, you know, this is the one thing that drives votes. At the end of the day, people vote by their pocketbook. They can talk about policy all day long, right? I don't like him for this reason. I don't like him for that reason. But at the end of the day, they vote by their pocketbook. If they are not better off, at the end of the day, they're going to vote for somebody else. And we see this in every election. You know, George Bush, the second, when we got through, you know, heading into 2007, 2008, the elections in November of 2008, we're in the middle of a financial crisis. You could have run the second coming of Jesus on the Republican ballot, and Obama still would have won because the economy at that point was so bad that people just wanted to change. And so it's going to be a very interesting election coming up if this economic data doesn't start to improve for the bottom 80% of workers. So, all right, wrap up the show for the day. And be sure tomorrow, of course, we'll have Richard Rosso, Danny Ratliff here for Financial Fitness Friday. The article on retail sales out tomorrow. Mike's article on the NFL draft on the website now, realinvestmentadvice.com. And our newsletter this weekend, I'll be basically going through this current correction and potentially what happens next based on some data there, particularly flows of capital. So again, that's all coming up on the website, realinvestmentadvice.com. Make sure you go there, get subscribed for our different services, and also be sure to like and subscribe to the channel. We appreciate you, and we'll see you back here next week.